Hi there. Welcome everybody. This is the inaugural podcast. This is a continuation of the radio and the TV that we've been doing for the last 4 or 5 years. And this is going to be the inaugural podcast. And what are we calling it, Cam?
Financial focus.
Financial Focus. So today is December the 18th, about a week before Christmas. It's about 5 o'clock in the afternoon, and I've got with me Kenneth Kuhn III, aka the Kenneth Kuhn III, aka Kenny, I got your number, Kuhn III, aka Cameron's daddy. With us today. Mr. Kuhn, would you like to say hi to everybody?
Hello, everyone, and I'm going to be playing second chair to Mr. Forehand today, and hoping I learn as much about this stuff as everyone else does.
This in no way is meant to be Air Force versus Marines. I'm just saying.
Yeah. Well, I you see the background here. I got the World War II flags and the
Yeah,
Marine Corps stuff, and I've got the rest of the room's covered in it. So,
I'm surprised there isn't a Grand out there somewhere.
a what? A
Yeah,
grand?
M1 Grand, yeah.
No, that's on the other side of the room. That's over there.
Okay, very cool. And we've got with us Cameron Kuhn. Cameron, introduce yourself. Say hi to everybody.
Hey everybody, I'm Scott's editor. I also work in the business, and I'll be kind of third wheeling it today, but I'm ready to get into it.
Okay. So we're actually going to interview Cameron for part of this conversation today. We're going to start this. This is a continuation of what we used to do on the radio, called the Crypto Corner. And this is where we talk about what's going on with cryptocurrency. Um, we're not going to give investment advice on this, but we're going to give information. So I was reading through and doing some show prep about this, and one of the things that I came across was this generational divide as far as investing is concerned. And when we look at what the vast number of people that are investing in crypto, which is almost 70% of the people that are investing in crypto are under the age of 30. So it is definitely something that has been adopted by the younger generations. And I was reading as to trying to figure out why. And one of the things that kept coming up, what that I kept reading about was that there's this generational thought or this generational malaise about that the investment tools that were available or were successful for previous generations, the younger generation feels like it's not. They don't feel like they have the same opportunity. So Cameron, what can you share? You're in that 20 to 30 year young range. What can you say to that? Can you explain it?
Yeah, I think the digital world has impacted that a lot. I think specifically with crypto, that's been around since I was probably about 10 years old is when that started, getting popular. And I think that really what that taught us was that money's more, especially nowadays, money is just, we don't really think of it, I think, the way our parents did. It's more just something on your phone, just something you can toss around. And then look at things and, the housing prices and just the cost of living nowadays on a relative scale is not um, near where it was when our parents were growing up or their parents when their parents were growing up. So, um, yeah, I think it's taught us to kind of have a negative connotation towards money, and overall, you look at where where wages are, where the average household income is, and it's relative to how expensive things are right now. It's has that hasn't gone up that all that much, like I said, on a relative scale. So
So there was a study that was done by Coinbase, and this is not an advertisement for Coinbase. And what they said in that study was that 73% of the younger generation of the 4,000 people that were polled said that about 73% of them said that they felt like their generation faces greater hurdles to build wealth than previous generations. Do you agree with that?
Very much. Yeah. I would one of the main milestones that I think people look at is being a first-time home buyer, and
Ah,
that's harder than ever. Um, More expensive and harder than ever. And like I said, it goes back to just when you look at the median household income through the United States um, relative to the housing prices, that's not an equal playing field. We're not playing on the same field that our parents or their parents were playing for on.
all right. So it's funny you focused on housing affordability, and that is the primary reason that the people who were in that study, that was one of the primary things that they all, not all, but a large portion of them referenced as being one of the key problems. The other problem that they had that they referenced, it was the housing affordability. Housing prices are so high, and debt for a lot of these young people because of student loans and the
Yeah.
concept that I can put my loan into deferment and it's not going to grow. That's completely wrong. And that's the other issue that they're harping on, is that housing prices are up, debt is up, and there's also this really alarming trend of people that are, 20 to 25 still living at home with mom and dad, not moving out, not getting out on their own. And I know, Kenny, I don't know about you, but when I moved out when I was 18, right? And
Yeah, I literally graduated, and 5 days later, I was at Paris Island.
okay.
Yeah, and I would add something to this conversation is that you, and as a parent of a Gen Z, I think it is technically, um,
Yeah.
they think differently about a lot of things. Um, they grew up in a digital age. When they were 2 and 3 and 5 and 7 years old, we had the smartphone. So they were born with one next to them, near them, even if they weren't using it.
Right.
And there is a tendency for you and I, we think of money, if we connotate money to something, it's a dollar bill or it's a coin in our pocket. And we can probably all remember our dad or our parents walking around with coins in their pocket. And that was money to us. And at in this age, they don't think of it that way. And then we have certain absurdities now that you didn't have when we were growing up. And that is kids, 20 somethings in college right now, athletes that are multimillionaires, many, many, many times over. And you have what is amounts to monopoly money. So it's a different worldview. Um, and I think that all adds to that factor of, you know, YouTubers, people like that, guys that make a living off of this format. And you got 19 or 18-year-old kids seeing these guys that they're gamers making $1 million a month off of streaming. So everyone's looking for that, the idea of, hey, work 30 years, stay at the same job, bust your tail, and come out on the other side and retire and have a pension. That doesn't exist.
Right. Yep. That's
Yeah.
definitely got to be a consideration. Is this kind of the thought process, Cameron, what your dad just described for you? Is this what's going on for you? Obviously, you're one person, not you don't speak for a generation, but is this kind of where this thought process for you is coming from?
I would definitely lean towards that. Yeah, I would agree with most of what he just said. I think that money right now for my generation and maybe the generation after me, um, who I believe is in high school right now, they're learning about these things. I think based on what they're just seeing on their phone every day, there's this mentality that I think a lot of us have that I'm guilty of too, of you just almost want to sit back and it's like it's gonna happen. I'm gonna make this money. I'm gonna it's like it's just you're just kind of sitting there. Because you see like he said, these streamers, these athletes, they're kind of just keep making money out of thin air. People on TikTok, people, that are selling on the TikTok shop, affiliates. So things like that, it's we like I said earlier, we've kind of learned that money has this digital um, personality for us, and it's not real almost. And that goes hand in hand with crypto and things like that. So, yeah, I would definitely agree with that. And I view it personally as a big negative, um, just because it's not real, and there's no real way to
So
to
the
quantify it.
decentralized dollar, or not decentralized dollar, but the decentralized um, cash is what what this amounts to. You don't, you personally don't think it's real. Is that what you just said? Did I hear you right?
Essentially, yeah, at times it seems like
Okay.
um, if you don't know the background or where that money's coming from, it can seem like that for sure.
Yeah,
Okay.
there's a sci-fi movie. It's pretty old, actually. I want to say it's like it's not Soylent Green or one of those, but it's like that age. And these guys would walk into this what looks like a commissary, and they would stack up some groceries and stuff. And then they would pull their sleeve up and go like this, and they would wave, and their arm would blink. There was a code on here, and it would blink, and it would see how many credits they had. Okay, we're not that far away from that. Here's this right here. Here's my Apple Watch.
Yeah.
You know why I wear this thing? Not for working out as much, although I do wear it for that. It's because when I go leave the house, I don't have to carry a cell phone on me. And when I want to go down to the store afterwards and buy a Gatorade, I just double click on this and wave my hand over it, and it's cha-ching. I've just paid. And you never see the transaction. You never feel the money come out of your pocket. There's a disconnect there. And we live in an age of instant gratification. Everything's the easy button. And if you have digital currency, a cryptocurrency, if you will, not the same as digital currency, but um, there is that idea that, and everyone's seen this, that, and it's being pretty well broadcast now that, hey, Bitcoin, for instance, there's a fixed amount of Bitcoin. It will never change. And there's the idea that, hey, it's only going to get more valuable, and maybe I can get that get rich quick scenario. Maybe it appreciates vastly over a short period of time, and the idea that you can use it in all these different formats and venues and stuff, and I think it's appealing to anybody who's grown up in that age.
Yep. I remember when I was younger and I first got into the markets, it was always, I can see how much money I can make. And if somebody else is doing it, why can't I do it too? And I get that. However, if you really pull the lens back, pull back the focus, then the ability for someone to become a Bitcoin billionaire, that ship might have sailed exactly because of what Kenny's talking about, because it's a finite resource that is originally was an experiment and now it's become a thing. But now you've got the market is flooded with so many different coins and memes and meme coins and things like that. It's hard to choose. And I think you can see that with the recent, I'm looking at, $24,000 pullback and the Bitcoin value as of today. And I'm seeing some Vegas numbers coming out of all places that are, you can place your bet. Is Bitcoin going to hit 80,000 or 110,000 first? And
Cameron,
that's
I'm sorry, what was that we were talking about yesterday? The site where you can bet on anything.
Kalshi, yeah.
Yeah, that's what you're talking about, Scott.
Okay. So the point is that, and there's enough people that feel one way or another. In the end, all of these investments, whether it's a coin or a stock, um, they all are driven, unfortunately, by emotional traders to a degree. And the emotional trader is usually wrong because the emotional trader is the one who loses money. And that kind of brings us to one of the things that we talk about here, which is in what we do for retirement planning and things like that. Our goal and our focus is not to hope that you have enough money, not to guess whether or not XYZ investment is going to go up or down. Our goal and our focus as stewards of the money that we have is to know where the money goes and is going, and not to lose sleep, not to worry about checking my phone first thing in the morning to see how much something lost overnight, to be in a position where I don't care whether it went up, down, or sideways. And this is something that Kenny and I and Cameron getting into it now that we do all the time. This is part of our practice as a financial service professionals. It's not, can I get you in a place that I can make you 30% per year? Yeah, I can, but you'll probably also have the opportunity to lose 50% per year. So there's no free ride. That's never been truer. It is always something that you can get lucky, but getting lucky is not a consistent means for growing and securing wealth. So
Well,
Kenny, go
yeah,
ahead.
yeah. It's one of the scenarios that I try to explain to clients, and I always ask a lot of questions. I want to understand the client's
Sure.
mindset, where they're coming from, what their history has been, what their experience is, to gauge their risk tolerance, you know, how they view taxes, because hope isn't a plan. It's just you have to have a strategy or an end game in mind. And you know, some of the talking heads out there that and actually very skilled people too that are part of Wall Street. One of the reasons that, for instance, New York as a state has such has such high restrictions on what we do is because it's a threat to Wall Street. They don't want a lot of people that are coming in there with index products or things that have stop losses on them that basically deter people. And the best example I can give is, if you look into the history of where the 401ks came from and mutual funds, which didn't exist until the 60s and 70s in any form. And everyone thinks it's a benefit program to get to help people, but it was really devised as a tax hedge for corporate America. And how can I get more money out of the working class guy? Because prior to that, you had to have a minimum. You had to buy a minimum of 100 shares. So you want to go buy AT&T stock, some blue chip stock, you got to buy 100 shares. A lot of people in the 60s didn't have $1,000 or more to put down. So how do we nickel and dime the working class guy? Well, we're going to take it out of his paycheck before he ever sees it. And then they tell you, oh, you're going to average 10% over a lifetime. No, you won't. You're going to average 11%, and then they're going to take away between 2 and 3 or 4% of that in commissions and fees. And when you start looking at all this, and then there's massive tax consequences down the line. And your Edward Jones of the worlds and the Charles Schwabs and the Vanguards and so on, they will not agree with any of this because their attitude is, you know, um,
They can't
they're
agree with it,
always
Kenny. It's bad for
no,
their business.
exactly. They can't, and
Right.
and it's just so that's why I believe in the system I do because vast majority of our clients are not multimillionaires. They're not people who can afford to lose what they've built.
Right.
It's just that simple. It's pretty common sense.
So the stuff you were just talking about, the invention of mutual funds and the creation of the 401k by Ted Brenna when he was back at Johnson and Johnson in the 70s. That you're right. The reason why I was there, it wasn't just what you said, but it was also to help create the pension that some companies had, but most companies didn't. It was to give a codified opportunity for corporations to participate and provide missing income downline for their employees. If you want to, anytime you're discussing something like this, there's the best case scenario of what it was built for. There's the worst case scenario of what it was for. And the truth is somewhere in between. So this is probably one of those situations where the truth is in between. It wasn't all about doing something that's good for the company, but it certainly wasn't all about doing something that's good for the employee. And with that being said, one of the reasons why those programs have problems is because they were designed with a market in mind, where one of the things you said, earning 10% per year. Back then, with the market the way that it was possible. It doesn't see that anymore. We're looking at an average S&P growth at this point of 5.9% per year over time, over 20 years. So how can you get 10% growth out of something that only grows at 5.9? And then if you take into consideration the other drags on growth, inflation, 3% per year, maybe. What was it? It was 9% 2 years ago or 3 years ago.
It depends depending on if you're looking at real inflation versus
Right,
reported inflation and what
right.
site you go to. Some places had it as high as 13 and you had back in the early 80s, it was 17 and 19.
Yeah,
It was
right.
crazy.
And if you can make 10% in a market that's got 17% inflation, that was easy,
Yeah,
right? Can't do that
it
anymore,
was.
right?
No.
So you got that drag, which is due to inflation. And then you have this other drag, which is due to tax. And what I'm looking at right now is for most retirees, we're husband and a wife in their 50s and 60s, both working these days, that income stream puts them squarely in the 24% or better or bigger tax bracket. And that is further inflated by the tax of the state that you live in, because that's just federal income tax. So the
Yeah.
point is, you're losing money every year because of inflation. The purchasing power you're losing every year is 3% because of inflation, number one. Number two, you're losing money every year in those types of programs that you're growing because your uncle, your father told you it was a good idea. Your dad's financial guy who learned the financial process of investing from the 1950s, which has been proven mathematically not to work. Okay. These are the people that you're taking this advice from. And a lot of these people are employed by who? The banks.
Yeah.
And because these people are employed by the banks, they have to toe that line, which is invest, keep investing, dollar cost averaging, right? No. So this is where we step in, Kenny, with the stuff that we're doing and the focus that we have, which is I don't want to make the banks rich anymore. I'm kind of tired of that. I keep $5,000 in my checking account and I get a thank you every year from the bank. Hey, Mr. Forehand, thanks for keeping so much money in your checking account. The good news is because you're keeping so much in there, we're not going to charge you a fee for you to keep your money in my bank. And oh, by the way, we're going to use your money every night as well. And we're not going to pay you any of that money that we make using your money, right?
Well, also then the money that you when you it's not even their money. It's the Fed's money.
Right.
It's yeah, I'll give you a really good example of a basic lack of understanding. And that's what this is about, is what we do, in my opinion, is about teaching
Yeah.
at a fundamental level. I have to change the way people see this long term. And I tell them this ahead of time. I tell them all the time, look, the terminology I'm going to use is not the formal technical terms for this stuff. I'm telling you this so it'll be a little bit more easily digestible. Okay. And I refer to things like IULs or annuities as private pension programs. Okay. You're
They are.
privatizing your own pension. And the reason I use that is because there was a three-legged stool back in
Yep.
the day. For my dad, that was a three-legged stool. There was a
Yep.
pension, there was Social Security, and then there was his savings, his 401k, whatever he
Right.
wanted to use. And the pension programs are, unless you're a federal or state employee, they're gone.
Yep.
Okay. Um, and then on top of that, you have, um, the 401k has, although it did pretty well actually through the 70s and 80s, in the mid 90s, it started petering out.
The
And then
interest rates were higher.
when the dot-com boom ended, it crashed and
Yep.
it has never recovered, and it probably never will really again in the way that we think of it. Plus, the vast majority of 401ks are put in mutual funds. And you have to understand that there's some fund managers change, they're promoted. One guy's really good at his job, the next one comes in, he's not so good. You can't count on this. It's very unstable. They're diversifying your money without you being involved in it. It's a haphazard methodology. And when you the one of the basic things I try to explain to people, circling back, is that basic math. And this is for a lot of people, they when I tell them this, they're like, "Oh yeah," but you can tell it never dawned on 'em. And when I in 2008, March of that year, I think it was, March, February, somewhere in there. I'm sitting at Dell, and I had heard wind of some stuff that even though I wasn't in this industry back then at that time, I still never really left it because I'd, been in it before and I paid attention. And I got wind of some stuff, and I moved everything into a bond, everything I had into a bond fund at the time. And that year I lost 1%. The gentleman sitting next to me, who was 62 years old, guy named Martin, getting ready to retire in 2 years. 20 something year Dell guy. He lost 40%, 39
Hmm.
point something in 2 days. And devastating is not the word for it. And then it was several months later, and I came back to him, and he's like, and we were talking. He goes, "Yeah, but I'm going to make it all back. I'm getting another 20% this year or something." And the next year it was like a 22% gain on whole. And I said, Martin, I said, look, man, if you have 100 grand
Yeah.
and you lose 40%, now you're at 60K and you make 20% of 60K, you made $12,000. You're at 72,000. I said, to get you back to whole again, you literally have to earn about 78%,
To break
almost
even.
double what you lost to break even. And I said, that will not happen over the next even 4 or 5 years.
Right.
It's
Yeah,
going to
You
really.
have to take into consideration the loss due to what we talked about earlier, inflation. And you're talking about obviously about the power of loss. So yeah, that's something that a lot of people misunderstand or I guess, even in some cases, it's almost like you're putting your head in sand. It's not that you don't want to understand; it's just you don't want to understand. I get it, and you're right, and that's why some of the stuff that we do here, Kenny, like the banking concepts that we do, and the IULs, and even the annuities, they're all designed to protect against that loss. There's a timing component to this too. And
Yeah.
so let's talk about that for a second. So if I have, like you just mentioned up earlier, $100,000. So if I have $100,000 and I put it in the market and the market loses 40% or 39% like it did in 2022, then now I have to go through that recapture process, the power of loss, and it takes me years to make it back. If I had that money in an annuity, most likely I wouldn't have lost a penny.
No, I
Yeah,
mean,
zero loss guarantee.
yeah, and full disclosure to anybody watching this about annuities. Okay. There's a whole bunch of different types of annuities.
Right.
What Scott and I are talking about is not variable annuities.
Yeah, we're talking about fees usually.
Yeah, and with the annuities, I mean, yeah, theoretically you can lose a little money here and there if you have if there's a fee associated with an index,
Right.
but it's like 0.095 or something, and even then, they guarantee you a full recapture at a certain point. You could
Yep.
have you could have the worst economy in the history of the world, Germany after World War One.
Weimar Republic.
Yeah, you could have negative numbers for 20 straight years, and you're still gonna make money in that 10th year. And the one thing I like about those products is because in our industry, there's a word you're not allowed to say, and that's guarantee. Okay. However, if a carrier writes it on a document, you are allowed to say that.
Yep.
And it says, and a lot of financial professionals shy away from those illustration pages that say guarantees because they're like it's zero. And I'm like, you're looking at it wrong, buddy. It's zero. It's not negative 20. They didn't lose a dime. Total economic collapse. You're whole.
Right. Going back to the part that we were discussing just a minute ago, timing. Timing is everything. And nobody has a crystal ball that works. Nobody knows when the market crash is going to happen. We just know as financial professionals it's coming. And I'm not trying to be the chicken little guy, but the reality is we're overdue. The market's overbought. There's an exodus that happened a couple of years ago. Unfortunately, it was a little late, and I'm going to use 2022 as an example. So if you were in the market, which means you had a 401k, you had a 403b, TSP, KEO, SEP, FIRST, whatever, you saw a degrade or a decline in the value of your retirement plan in 2022. And it went down almost 40%, went down 39% before it started bouncing back. And it did start bouncing back in the same year. So it lost 39 and then came back so that it finished the year down only 16, which is pretty good. But here's the thing. If you were in the market then you rode it all the way down, you rode it back up 16 points, but you didn't really make back 16 points. If you were in an annuity, you wouldn't have lost a penny, and then you would have had that gain that would have come back, but you wouldn't have captured it either because you were still down for the year. And this is where the timing comes in. Well, what happens if you had that same $100,000 instead of investing it all on January 1st, you split it up. You put 50,000 in January, 50,000 in March. The 50,000 in January, the level finished 16% lower than it started, so you would have had zero gain. The 50,000 in March, however, that would have recaptured that 16% gain, would have ridden it all the way up. So in that that March component, you would have had plus 16%. In the January component, you would have had zero. And if that's the total $100,000 investment, then you just made an 8% gain when everybody else lost their rear ends. This is about mitigating timing risk or sequence of returns risk, as it's called in the industry. So the last thing I want to talk on here is these things that Kenny and I are talking about, these tools, like Kenny mentioned an IUL, which is a contract with the life insurance company, guarantee of no loss, going to have growth over time. Got a death benefit associated with it, creation of legacy. We talked a minute ago about the annuities and how those can work. And we're not talking about, as Kenny so aptly put, this is not about variable annuities, just like we're not talking about variable universal life policies. You can lose your rear end in those programs. We're not talking about that. We're talking about the stuff that guarantees that you can't have a loss. And it's not us guaranteeing it, it's the carrier. Like you said, Kenny, it's the carrier because the carrier puts it in writing. The final thing that we want to discuss just briefly is banking. And I'm not talking about going down to your Wells Fargo account. I'm talking about infinite banking or debt-free life banking, or sometimes they're called cash flow banks, or sometimes they're called smart banks. And this is really nothing more than a contract for life insurance that allows us to store and grow cash where the IRS really can't see it, touch it, or tax it. And that's something else that Kenny and I use all the time. And these are, folks, these are all parts and pieces of a plan. There is no one thing that's right for anybody. Not one. Sometimes you can mix them and match them, and sometimes you have two. I've got clients that have three, all three kinds. I've got clients that have 18 different programs. It just depends on what your goal are and what your plan is. And if you're new to this and you're cruising TikTok and swiping, and that's how you're consuming your information, I'm glad you're consuming information. Just be very careful because there's a lot of people out there talking about some stuff that really isn't real.
Yeah,
And you can lose your rear end. Go ahead, Kenny.
the guy the other day, I forget the race car driver that was suing
Kyle
me.
Busch.
Yeah. And when I saw that, I looked at Cameron, I started laughing. I'm like, and I don't know the guy from Adam. Okay, never met the man in my life. I'm sure he's a decent human being. Number one, the likelihood that that was done in a manner that we would do it is highly unlikely. The circumstances, getting a professional race car driver insured, all those, that's virtually, it's so difficult. That is at a much higher level and a whole different side of our industry. Okay. Only a handful of companies will even underwrite that kind of stuff. And then he says, we lost all this money and they said this. And I said, no, you didn't. You didn't lose money. What it is you're a 40 something year old or 30, late 30s, early 40s race car driver. Your risk associated with you is astronomically high. The vast majority of your money is going to pay for life insurance. So yeah, you were depositing money in there, but you're expecting this to work like a depository account, and it's not the way it's set up. And so there's tons of misinformation out there. And what I tell everyone is when I talk to them, like, look, my job as an advisor is to understand your specifics and then apply. It's the right tool for the right job. There's no one size fits all. If you've ever done any work on your own home or a car and you go down to the Home Depot or whatever and you say, hey, and the guy tells you, here's the universal fit. The universal fit never fits. You end up having to cut it and fix it. You want the perfect fit. And that comes down to an analysis with a professional that knows what they're doing, that can explain it to you, that can help you. And quite simply, it's what works for one person that's a 30 something or a 20 something that is perfect health and so on. And And people are like, well, I don't want the life insurance. But I don't need that. I'm looking at the financial aspects here. And I'm like, you're looking at it wrong. I was like, and explained it like this. I said, you have these assets that you're taking a lifetime of work, a lifetime of your labor to build. And you built this asset. And I said, what we're going to try to do is we're going to try to take that asset and we're going to try to completely mitigate or extremely minimize any tax footprint. That's a 20 to 30% gain right there. Boom, done. I was like, that's number one. Number two is you're going to get older. That's the one finite thing there is time. You're going to get older. And when you get older, you're going to have this asset that you worked your lifetime for. Do you really and truly want that squandered? Or would you rather have a big death benefit associated with that, that, by the way, actually protects it and makes it a non-taxable footprint? And then you can leave that money into a trust, or you can leave it as if you want to donate $1 million to a you know, a charity in your name, or whatever you want to do, you can leave a legacy that way. And then the third part of that new third three-legged stool is, hey, by the way, we're going to take care of your long-term care concerns. Because most of the products we deal with, especially the ones that I really like, there are a lot of your more typical long-term care scenarios that will be covered by this. And if you structure it right and you know how to use it and you come back to us, we're going to take that money and we're going to annuitize it for you so that in a long-term care or a skilled nursing, or in my case, I had a client with a stroke and his wife's wondering, how am I going to pay for the home health care? And I'm like, you don't have to worry about that. You know what we're going to do? We're going to get you $1,800 a month for the rest of your life, by the way.
Right. So you're right. There's lots of tools out there. There's lots of different ways to use them and implement them. Having a conversation and a meeting with a professional is critical to making sure you get what the right thing is for you, not the neatest and greatest thing that's new and shiny out there. All right. Last thing I want to say, got a book coming out, and that book is due out sometime in January or the very latest early February. It'll be available on Amazon and Kindle as and hard copies as well. And it's about the stuff that Kenny and I are talking about. It's about the safe kind of permanent wealth planning. It is biblical because it's meant to reference scripture and things like that. But if it's in the good book and the good book is telling us to do this thing, it works. So that's all I got. Kenny,
Yeah,
anything else?
I'd like to chime in on that.
Okay.
For anybody that is gonna, is awaiting this book or is the first time hearing about it, I think for people my age in a world full of misinformation and like we were talking about most of this podcast, confused young people on how to manage money and where it's going to come from. I think that a book like this is going to be able to really just help a younger generation on how to look at money and coming from a place like of religion. I don't think I think that's pretty hard to beat. So I would
Nice.
encourage everyone to check it out.
All right. It's called Kingdom Banking Legacy by Design. Be out next month or shortly after that. Kenny, you got anything else you want to close us out with?
No, no, not really. I think that what we offer is even when I see other insurance agents and other brokerage services and things of that nature, it's unique. It is unique. It's I can't tell the number of people I talk to on a weekly basis that are just like, hey, nobody took the time to explain that to me. And you need to, when you make a decision, it needs to be made from a standpoint of good decision or bad decision or whatever. It has to be your real decision, meaning you have all the facts, not just a slanted view and somebody trying to sell you on something. And that's the one thing I would tell, and I know this is true with Scott, any of my agents, we don't sell.
Right.
I'm not trying to
Very true.
convince you of something. If it doesn't work, I'm going to tell you, hey, not for you. Look at this. I've even pointed people toward things that we don't offer.
Right.
This is about truly changing people's lives.
Right. Well, Kenny, thank you for coming. Thanks for your comments. I appreciate you and appreciate having the opportunity to do this with you. Cameron, thank you very much for your perspective and for your time, sir. And I wish both of you a happy and safe and Merry Christmas as we're about a week out. And have a great night,
Two.
everybody.
You too.